You've done the research. You know what an ETF is. You might even know which one you want to buy. And then you open a brokerage website. And suddenly, there are account types you don't recognize. Market orders, limit orders, KYC verification, order routing, a disclaimer that's 3 pages long. And you close the tab. That's what this video is for. I'm not going to tell you which button to press in which app. Those tutorials go out of date every time a broker updates their interface. What I'm going to give you is the decision layer, the framework that works regardless of which broker you choose. By the end of this video, you know exactly what to look for, exactly what to have ready, and exactly what to do on day one. Quick note before we start. Nothing in this video is financial advice. I'm not a licensed financial advisor. This is educational information to help you understand how things work. One more thing. The broker comparison I'm going to show you reflects data from May 2026. Fees change. Features change. Terms change. Always verify on the broker's official website before you open an account. Three things today. First, how to choose a broker, not which one to pick. How to evaluate any broker yourself, so you can make the call based on your situation. Second, what it actually takes to open an account, the documents, the process, and the one thing most beginners don't have ready. And third, what to do on day one, placing your first order, setting up automatic investing, and the 5 things that cost beginners money in the first 90 days. Let's start with the broker. The marketing around brokers is almost entirely about price. 0 commission, €1 per trade, free ETFs. And price matters, but it's not the only thing that matters. There are 4 things I'd look at before I open an account anywhere. The first is regulation. In Europe, any legitimate investment broker has to operate under MiFID II. That's the EU rulebook that sets the minimum standards for investor protection. On screen, you'll see what MiFID II means in plain English. The short version: if a broker isn't MiFID II regulated, you have no legal protection if something goes wrong. You want to know which national regulator oversees the broker. BaFin in Germany, AMF in France, AFM in the Netherlands. This is publicly visible, and it takes 2 minutes to check. The second thing is, what happens if the broker fails? In the European Union, your uninvested cash and your securities are protected differently. Uninvested cash, money sitting in your account, not yet invested, is covered by the Deposit Guarantee Scheme, up to €100,000, but only if the broker holds a banking license. Your actual investments, the ETFs you've bought, are held in custody, separate from the broker's own money. If the broker goes bankrupt, your shares are still yours. The broker doesn't own them, they just hold them on your behalf. So the risk isn't losing your ETFs if the broker fails. The risk is losing uninvested cash sitting in your account, which is another reason not to leave large amounts of cash sitting uninvested. The third thing is what it actually costs. The headline fee is the trade fee, but there are 3 other costs that are less visible. The first is the foreign exchange conversion fee. If you're buying an ETF priced in US dollars from a euro account, the broker converts the currency. That conversion has a cost, and it varies a lot between brokers. The second is the spread, the gap between the buy-in price and the selling price. On a liquid word ETF, this is usually a few cents, but it exists. And the third is something called payment for order flow, or PFOF for short. Here's what that means. When you place a trade, Your broker has to route that order somewhere to execute it. Until recently, some brokers were getting paid by market makers to route your orders to them specifically, not necessarily to wherever you'd get the best price. The EU banned this practice from June 2026. Some brokers have adapted cleanly. Others have found workarounds. It's worth knowing where your broker stands. The fourth thing is whether the broker supports how you want to invest. The most powerful investing habit for a long-term investor is automatic monthly investing. Same amount, same ETF, same date every month. No decision required, no discipline required. Not all brokers offer this, and some brokers offer it free. Others charge per execution. If you're planning to invest monthly, this matters more than the trade fee. On screen is a comparison of 4 of the most widely used brokers in Europe: Trade Republic, DEGIRO, Scalable Capital, and Interactive Brokers. A few things worth pointing out. Trade Republic and Scalable Capital both offer free savings plans from €1. DEGIRO doesn't. If automation is a priority, that's a meaningful difference. DEGIRO and Interactive Brokers both have strong regulatory profiles. Interactive Brokers is the cleanest on order execution. It doesn't use payment for order flow at all. But it's also the most complex platform and better suited to larger portfolios. For most beginners, starting with regular monthly amounts into a Word ETF, the neo brokers, Trade Republic or Scalable Capital, are genuinely fit for purpose. The table is dated. Verify before you open. One last thing on broker selection. Check that the broker is available in your country. Not every broker operates in every EU member state. This is always visible on their website. Before you open an account, gather 4 things. 1. A valid government ID, passport or national identity card. Either works. 2. Proof of address. Not all brokers ask for this, but some do. A recent utility bill or bank statement with your name and address is usually enough. 3. Your bank account details for funding. You link a bank account to deposit money and to withdraw. Use a bank account in your name in the same currency as your brokerage account where possible. This avoids conversion fees on every deposit. 4. Your tax identification number. This one catches people off guard. Every EU member state has one. In France, it's the Numéro Fiscal. In Germany, it's the Steueridentifikationsnummer. It's usually on your tax return or your tax office website. Find it before you start. Otherwise, you'll be halfway through onboarding and stuck. The onboarding process itself is now almost entirely digital. Most neo-brokers complete identity verification through the app, a quick video check or ID scan. This is called KYC, Know Your Customer. Every regulated broker in the EU is legally required to verify your identity. It's not optional for them, so it's not optional for you either. It takes about 10 minutes if you have everything ready. Most neo-brokers activate your account within 1 business day. Interactive brokers typically takes a few days because their verification process is more thorough. When you open an account, you'll be asked what type you want. The one to open is a standard investment account. That's the account where you buy real assets, real ETFs, real shares that you actually own. Some platforms also offer something called a CFD account. A CFD, contract for difference, is not an investment. It's a bet on whether a price goes up or down. You don't own anything. You're just speculating on the movement. CFDs are high risk. Most retail traders who use them lose money. That's not an opinion. EU law requires brokers to publish that statistic. Check the small print on any broker's CFD page and you'll find it. If you're here because you want to invest for the long term, you want a standard investment account, not a CFD account. You're verified. You've funded your account. Now you want to buy. Before you search for anything, one important habit: search by ISIN, not by name. An ISIN is a 12-character code that identifies exactly one specific fund. If you search for a fund by name, you might find 3 or 4 versions of it. Different currencies, different share classes, different domiciles. Searching by ISIN takes you directly to the right one. You'll find the ISIN of any ETF on the fund provider's website or on a comparison site like Just ETF. When you place an order, you have 2 main options. A market order executes immediately. You click buy and your order fills at whatever the current market price is. Fast, simple, no friction. The small downside: you don't control the exact price you pay. On a liquid ETF with a tight spread, this is usually fine. A limit order lets you set a maximum price you're willing to pay. Your order only executes if the market reaches that price. More control, but if the price moves away, your order doesn't fill. For a beginner, placing a regular monthly purchase into a broad word ETF, a market order is almost always the right call. The difference in price is usually negligible, and simplicity at the start is worth more than the precision. If your broker offers a savings plan, and several do, set it up on day 1. The mechanics are simple. Choose the ETF, choose the amount, choose the date. Monthly, same date, every month. You don't have to decide when to buy, you don't have to remember, you don't have to watch the market. The account does it for you. And over time, this habit, buying regularly regardless of price, is more powerful than almost any other decision you can make as an investor. Because you buy at all price levels, the highs and the lows, and the average cost tends to work in your favor. Your account is now open. Your first order is placed. Your savings plan is running. Now, the most important thing you can do is not undo all of that in the first 3 months. 5 things to watch for. 1. Checking the price every day. It will go up, it will go down. It will do both in the same week. None of that is a signal. All of it is noise. Checking daily turns you into a reactor, not an investor. 2. Reacting to news. Every week there will be a headline that seems like a reason to sell. Markets have priced that information in before you read the article. By the time you act on news, the move has already happened. 3. Adding too many products too quickly. One broad word ETF running consistently is a complete strategy. You don't need 6 ETFs in the first month. Complexity doesn't equal sophistication. It usually equals confusion. 4. Confusing a dip with a mistake. If your portfolio drops 10% in month 2, this is not a mistake. That's normal. That's the price you pay for the long-term return. The investors who build wealth over time are the ones who stay in the market when it feels uncomfortable. 5. Waiting for the perfect moment to invest more. The perfect moment doesn't exist. Time in the market has historically beaten time in the market. Done is better than perfect. Consistent is better than clever. Three things to do, 30 minutes total. First, compare 2 or 3 brokers from the table in this video for your specific country. Check they're available where you live. Check the savings plan terms if that's how you plan to invest. 10 minutes. Second, gather the 4 documents: ID, address proof if needed, bank details, and tax number. Don't start the onboarding until you have all 4. 10 minutes. Third, open the account before the end of the week, not next month. The account takes 1 business day to activate. The sooner it's open, the sooner you can act. 10 minutes. If you've watched this far, you have everything you need to open an account and place your first order. The research is done. The framework is in your hands. What's left is the 30 minutes. If you haven't seen video 2 yet, that's the one on which ETFs to actually buy and how to think about strategy. The link is in the description. This video was about where and how. Video 2 is about what. Between the two, you have the complete picture. Money is a tool. If you don't learn to control your finances will control you.